So we had someone ask, what is a real loan scenario? What does the cash flow look like on a business like this? And so this is a business we broke down previously. It's 3.5 million asking, 1.4 million in cash flow, probably about a million in EBITDA, to be determined, obviously, doing 4.5 million. And there's a full on management team and so on in place here. And so what they were asking is, with something like this, what is it really going to look like when you start looking at the numbers and you break down what you're actually going to be paying the bank, what the fees involved are, what's the cash flow, even though they've priced it well because they have these license requirements. And so that's what I broke down here so I can kind of show you what this looks like. So if you looked at the previous video, these numbers haven't really changed. We're just assuming the cash flow is real, and that this is after taking into account expenses. Obviously, you need to adjust accordingly. But this is why it's so important not to overpay unless you're pushing that overpayment into seller finance or something deferred. And pretty much why even we try and keep the loan amount to high end three, maybe 3.25 times whatever the cash flow or EBITDA, effectively the net profit after all is said and done of the business. The reason why we try and keep it to that is because there's other fees involved when all is said and done. There's fees for the bank, there's fees for due diligence, there's fees to close, there's all these other things that you have to take into account. And then even working capital, right? What happens day one if these guys strip all the cash out of the business? How do you operate? Now, normally we like to have 3 to 6 months working capital left in the business, but you never know what the seller's advisors are going to say, or their accountants are going to say, or their lawyers are going to say, or any of the half a dozen or dozen people involved in the transaction on their side. So, assuming a pretty typical scenario here where you're buying a business, the owner is going to strip out a lot of the cash day one, and you're going to be left effectively with the business, and then you got to go and get a loan based on a reasonable multiple or reasonable negotiation here. We're just going to use the listing scenario in terms of numbers here. So, 4.5 million revenue, 1.4 in cash flow. We'll just call this net profit for the sake of simplicity here, asking 3.5 million. So they're asking for 2.4 times whatever their cash flow is. Now, when you go to do a SBA loan or really any business acquisition, there's a few fees that are involved in that. So, due diligence, your cost after the letter of intent has been in. So, after you've negotiated an overall price point, the cost of a lawyer and accounting firm to come in, verify numbers, verify there's no litigation, verify all the things involved to make sure that it's a sound business. And most SBA lenders will usually have their requirement on what type of due diligence they require. And oftentimes, if you're not quite sure, you can usually reach out to the SBA lender and say, hey, can you send me over a list of what type of due diligence requirements you have and what you would expect in a case that the business is relatively clean. And effectively, for those that know a little bit better, what you're really looking for is everything short of a quality of earnings. Quality of earnings being what large scale acquisitions use to verify information. And often a quality of earnings can run 30, 50, $100,000 on a small business. It can be hundreds of thousands on a bigger business. We want everything just short of that. We don't need the 50, 100, 200-page document that goes along with that, but we do want a similar level of quality checking and so on. And so usually that runs in the realm of about 1% of the overall purchase price. Oftentimes you can get this down within our network. We usually get this down to about 15 to 20,000. And if we pay cash in hand in terms of like paying them up front before the deal's done, usually we can get that even down to 12,000 or less. And oftentimes we just assume we'd like to roll it into the loan, and so that's part of the fees there. So we're assuming 1% here, that you're only having them get involved after you've structured a deal, just to satisfy the lender and also make sure there's nothing glaringly obvious there that's an issue. Then you have the SBA guarantee fee. Now, for any SBA loan, there is a guarantee fee. It's a highly formulated calculation. There's an actual formula based on size of business, based on the total dollar value, and it's calculated that way. I made a rough estimation here, just so that because I'm going to use this calculation, this formula moving forward, and some other breakdowns here. So I made it a general formula, assuming the highest end of their fees in terms of overall, and also assuming that we're paying about 85% loan versus 15% seller finance here. So in total, this is about right for this size of business. But if you bought a smaller business, this roughly would be a smaller ratio by almost about half. So that's what I mean by it's a rough calculation here. And it is a formula based on the loan size and the amount being guaranteed by the SBA. So there are calculators out there for that, but generally assume the ratio is going to be similar. It's always good to over assume just in case you have to restructure the deal later on. Then loan origination fees. This is what's charged by the bank to actually put the loan into place. I'm assuming somewhere in the range of 2%. Sometimes it's more, sometimes it's less. For business of this size, especially with the SBA, it has to be within a reasonable limit, as the SBA charters say. And they do get audited on that. Banks get audited on that every so often. So they're not likely to charge the higher end of 3% on a deal this big, because a loan origination fee of $100,000 is significant, enough so that it might raise some red flags. So 1-2%, somewhere in that range, is typically where you want to be. Sometimes you can negotiate this, especially if it's a straightforward deal. We always try and somewhat push this down a little bit, as close to 1% as possible. But it always just depends on the size of the deal. Then miscellaneous closing costs. There's always stuff that is involved in the closing, whether it's paperwork for your share purchase agreement, whether it's review of the counters back and forth during that process, anything involved in getting the deal closed. We typically assume 1%, high end 2%. So that means for a business of this size, high end might be as much as $70,000 in miscellaneous closing costs just to get paperwork done or otherwise. It's just what it takes. The bigger the deal, the more expensive it is. The smaller the deal, the cheaper it is typically. So if you're buying only $1 million business, you might only have $10,000 in closing costs. But when you're looking at more sizable businesses, it does get up there. And so that's what we're assuming here, is about a 1%. Then working capital. So business of this size, I am assuming that operating expenses, the rough way to do this, you should calculate it during this due diligence phase here. These guys, you can ask them to calculate the specific for you based on the financials that they see. The rough that we do is we look at the business, we look at operating expense, and we say what's half of that. So if the operating expense for the year is an operating expense being things like accounting, like office staff, like software, things that are within your control to maximize, streamline for profit, whatever you need to do to keep the business afloat. Not things relating to delivering service. That's cost of goods. There's no drastic way to change that. Those are things that are out of your control. Operating expenses stuff typically within your control, or mostly within your control. So what we do is we assume, scroll down a little bit here. We typically assume 6 months of that expense for the previous year is about what the working capital requirement is, to have lots of wiggle room. 3 to 4 months for little wiggle room, but enough to operate. So personally, we usually like to go for 6 months. So I'm assuming $4.5 million in revenue. There's probably a lot of hard cost and materials, so it's probably about $1 million in operating expense. So about half of that being $500,000. That's probably reasonable for this size of company. You can also, as a general estimate, take somewhere between 7 and 10% of the total revenue, but it's hyper general at that point, because there are businesses that operate with 50, 60% net margins. And so assuming half their revenue as an operating expense and working capital expenses is excess. So the easiest way, take the operating expense. It's everything listed as OPEX or operating expense in their profit and loss statements and their financial statements, and just divide it by 2 for the year. And just assume that's probably where you need to be. If you want to be really, conservative, you can take about half of that number if you're willing to be less conservative and you really know what you're doing. If you don't really know what you're doing, stay safe, stay in the conservative zone. Then buy side advisor. We have folks ask us all the time, what do our fees look like if we go and do a deal? This is what our fees would look like generally if we were to go in and help someone do this deal from end to end. You meaning our full service delivery of everything we do. So everything from finding the deal to helping you fund the deal to helping you do this type of calculation and analysis to vetting and going through all that to helping you pass through an advisory to close everything that would be necessary to get to a closed deal on a rapid basis. That's what this buy side advisory fee would be. It's not always a necessary fee. Obviously, if you go and do a deal by yourself, that wouldn't be involved. But we usually, we obviously, we work as a buy side advisor. So this would be what our fees would look like accordingly. And they're just being rolled into the loan, same as everything else. So when you take all that into account, what you previously might have had is 85% of this $3.5 million. And let me just calculate that here because I forgot to add that as a field here. So about 2.9 million is what it previously might have been, is what you'd expect that you'd go to the bank for before you account for really all the fees involved in it. And then at the end of the day, now what it actually looks like is 3.8 million. So almost another $800,000 in additional fees. And I mean, additional fees and things being working capital, the biggest piece of it. So that way you have cash on hand day one. And you're not having to pull that cash out of your own pocket and dump it into the business. Now, if you also get seller finance at 15% on the overall of that, you do your 2-year deferral, you're financing 3.8 million at a typical interest rate. And I mean, Bank of Canada cut their interest rate, so potentially the US might follow along as well. And so maybe it'll be 11.25 or just 11% flat. And what you end up with is still a scenario, because the business is well negotiated in terms of purchase price here, obviously assuming cash flow pans out, you are debt servicing 2.25 times, meaning your debt service is covered by a multiple of 2 and beyond 2 by the cash flow of the business, right? The business is cash flowing 1.4 million, your total debt payments are 600,000. You're making 2 times in excess of what you need just to cover debt service of the business and still be able to operate efficiently or operate as is. And then your cash in pocket that you can put into your pocket at the end of the year, obviously minus taxes and everything else, because this is cash flow. This is a cash flow before interest and tax payments and things like that. $800,000. So you can basically pay yourself probably a $300,000 to $400,000 a year salary in order to still have some cash sitting in the bank account at the end of the year, cover your taxes, sit there for just further working capital requirements, pay off the bank, pay off seller finance, do whatever you need to do there. Maybe it's additional trucks or otherwise you got to buy. But you can still pay yourself $300,000 to $400,000, have a lot of cash allowance, or pay yourself maybe $600,000 and still have some cash allowance. So this would be a good negotiated deal. Now, what this might look like, and the reason why I mentioned at the start, we like to look at 3.25 times, 3.5 times as a total on the loan side, is because if we flip this all of a sudden and we say, hey, if I was to pay, let's see, 1.4 million, if I was to pay 4 times, right? So this is, 4 times of this approximately. I'm doing round numbers here, but generally this goes up by a good bit, right? You're paying almost 4 times on it. All of your fees associated typically go up, right? There's a higher guarantee fee. There's a higher loan origination fee. There's a higher due diligence fee because it's a bigger company. There's more stuff to look at. And at the end of the day, your debt service drops into the poop. It completely flips upside down. Now that said, you're still making profit at the end of the day. It's not like there's no cash left to put in your pocket at the end of the year. But this is risky, right? This is a risky ratio, meaning if something goes wrong, you have 1 bad month, maybe 2 bad months, you could wipe out your entire profit, and you could have $0 at the end of the year after you pay off your debt. So that's why you really got to make sure you negotiate well. And typically, what we would do in a scenario like this, if they were really asking this and they said we're not going to budge on what our asking price is, we just say, cool. So what we'll do, let's increase and ramp up the seller finance. Let's decrease the amount that we're financing, And so basically, I have this as a hard set calculation here. We'd reduce this down, and then all of a sudden, we're getting closer back to a point where if shit hits the fan, we're still okay. And so that's that's something you got to look at. That's the reason why people pay us as buy side advisors. That's the reason why people work with brokers and otherwise as well, is to be able to understand this better, have someone else look out for that for you. But that's overall, that's how we look at us at a listing scenario. That's how we look at the loan side of it, and how we account for cost associated to ensure that it's always cash flowing. And so a big one for us is, we're almost never going to pay a 4 or 5 times on a business unless they're really willing to play ball on the structure of that business. Usually if we see something between a 2.5 up to 3.5, that is an okay business. You're going to have cash left over at the end of the day, for all the worst case scenarios. And you should account for that always. You can't account for everything being perfect all the time. So let us know if you have any other questions. Let us know if you want me to go deeper on any particular piece of this, or you want me to explain any of these pieces better. But I wanted to give you an idea of what this really looks like as a calculation, so you can see, what goes into it to understand how these numbers flow.